want to welcome everybody to our program today. This is the Compliance Forum. This is our first installment for 2022. We do 4 of these each year. 3 of them are of the Q&A variety. This first one is going to be a lending compliance Q&A. We also do a deposit. We do a BSA AML. And then my favorite one we do in the fourth quarter every year. It's a look back and what lies ahead. And basically it's a what did we miss and what's going to happen up there on the horizon. And so we do those. They're free. One registration does get your whole team in, but you can have different registrations on this. We're going to take your questions today, as many as we can during the 1-hour time frame. So I've got just a few housekeeping things here as we get started. First off, my name's Jared Moyer. I'm going to be the lead today, but my teammate Diane Dean, there she is. She's going to be playing the role of moderator. So if you've got a question you'd like to have considered to be included during our program today, many pre-submitted, but we're going to take some live from the field as well. I need you to go to the Zoom control panel. There's a Q&A button and you can start typing your questions in there. Diane will get them. And like I said, the goal is as many as we can during this 1-hour time frame. Now, the program is being recorded. So if you don't quite catch something, because we're going to go along at a pretty good clip today to make sure we get as many as we can in, you can go back and listen to this again. Maybe make note of when during the hour of the program the item is that you want to go back and listen to, or maybe you didn't quite catch it all, but we do provide the recording at no cost so that you can go back and listen to it again or share it with other teammates that maybe weren't here today, or you'd like to have them hear that particular message along the way. If for some reason you're having audio, visual, or technological issues, my teammate Mindy is standing behind the scenes. Do me a favor, use the chat function to communicate with her, and she'll try to get you back up and in the program today. I've got some closing announcements that I'll take care of at the end of the program. Otherwise, you know what, Diane, I think it's best we just get to it and find out what questions they have. And so before you get started, I'm going to stop actually sharing the screen here because we're going to make Diane and I the focus here for the next 58 minutes or so. And then I've got some slides I want to share with you before we all close out here. So give me just a moment here. I'm going to stop sharing my screen. There we go. All right, Diane, the floor is yours. Let's lead them on through some questions and we'll try to provide some plain English answers.
Okay, the first one we have is related to fair lending. We have a set interest rate that is similar to our unsecured rates that we charge on all loans under a set amount, secured or unsecured. Could this be a disparate impact issue?
So, you know, fair lending, it's so easy to throw that card down. In fact, I think it was just a week ago, we did our fair lending webinar for the year where we refreshed that and provided to everybody. And we had some new stuff because fair lending has been hot and heavy just in the last couple months. And there's some, I want to say new priorities, but fair lending is not new, but they're re-emphasizing, re-energizing where they're going to go with it here. So fair lending is an easy card to throw down. Could there be a disparate impact with the scenario presented in the question where we have this set dollar amount, anything below that is this set interest rate? I suppose there could be. What you always have to look for is what's the impact to the area, the people that you do business with that sort of decision. For example, if there's a demand for loans beneath that amount at that interest rate, but they're majority minority customers, we might need to reevaluate things. Maybe we need to have a discussion with our examiners because there's also a profitability thing there too, but they're going to care a lot less about profitability than they are about the fact that a majority minority customer base is receiving this higher interest rate than maybe somebody that's not. So there certainly could be. There's a whole lot more research and due diligence that would have to be done than just what's included within that question.
Okay, we've had examiners challenge us about charging single applicants $15 for credit reports and $25 for 2 borrowers on the same report. The examiners would rather have us charge the single borrower $15 and the 2 borrowers $30. However, it doesn't seem right to upcharge 2 borrowers by $5 just to be fair to the single borrower. And they're just asking, is it better to risk the fair lending violation here or risk upcharging the cost of the credit report?
So we've really got 2 different things. We got the fair lending issue, and I'll talk about that in a moment, but then we've got a separate RESPA Section 8 upcharging. Okay, neither one of them are good. And so I'm going to choose to have a problem with neither. I'm going to avoid issues with both because both are big deals. So I'm not going to upcharge. So that's the last half of the question we're going to answer. Now, let's go back to the issue and why it's present in the first place. The people that you buy your credit reports from, I'll go back to, I think the notes I have here, $15 a piece for an individual credit report. And then if I have a joint credit report there, and I think it's tied to marital status, right? Is that what I'm reading between the lines here?
Yeah, they don't say that.
They don't say that, but I'm guessing. So we have this joint married individual's credit report that is $25. Well, I'm not a rocket scientist at math, but I can do 15 times 2 is 30 and $25, and they don't add up, right? And so what it appears on the surface is that we're charging $30 for unmarried applicants and $25 for married applicants. Now, I am stepping out just a little bit here and making an assumption that the difference is solely due to marital status, but I can't see any other reason why we'd be charging more for single versus a joint application. And this is a very common thing. I can tell you, our review team, we're lucky. We get to see 3-4 different banks every couple of weeks and how things are done and how charges occur, how third-party interactions go. And this is one that we run into a lot. So this is not something that's new. And I absolutely would agree with your examiners that you shouldn't be doing this. It's a fair lending issue and could also be an upcharging issue on RESPA Section 8. The answer is simply to charge 25 for the joint application, and then whatever 25 is divided by 2 for, so $12.50 a piece for those individual credit reports.
Okay, this next one is on the Section 1071 rule. What is the timeline looking like for 1071? I know the comment period ended earlier this month. How soon do you expect us to see a final rule?
So the comment period did end, and we're paying very close attention to this. We've done a few webinars on it. If you want to get caught up, they're in our library, available on demand. But the runway kind of looks like this right now. What we're anticipating is a final rule by June sometime. Why June? Because they've said that they're looking at an approximate 18-month time frame for financial institutions to get up to speed and ready to go on this. Included within that 18-month time frame is a 12-month calendar year practice session. So if we put all that together, final rule by June, mandatory compliance by January 1st, 2024, that would be the 18-month window. And that would also put the calendar year 2023 as that practice year. In the proposal, they said that they are going to provide you this 12-month window to practice, but not longer than that. So what we're looking at is final rule by June, mandatory compliance by 1/1/24. At least that's what the crystal ball looks like today. Could change tomorrow. We're anticipating very much what they're going to have to say about the comments that were provided on the 1071 proposal.
And staying with 1071, if a loan has multiple pieces of collateral and one of them is an investment property, is the entire loan then excluded as a covered transaction?
Yeah, so there's this carve out in 1071 that says if you have a loan that's secured by a dwelling that is a rental property, investment property. So it's got to be 1 to 4. It's got to be like a rental property, something like that, investment property. But the key is it cannot be planned or be dwelled in by the applicant or the principal owners. So if the loan's secured solely by that, we know we can carve it out. But what if it's that and other collateral? I think you can still carve it out. Now, what if the other collateral includes something other than that? The regulation doesn't get into that. And so I'm going to save the what ifs here to say, let's see what happens when that final rule gets pushed out, because this is an area I expect there to have been a lot of comments on and that we'll get some feedback on it.
Okay, moving on to flood insurance. Can you summarize the best way to determine insurable value for flood insurance purposes?
All right, so this one was pre-submitted, and I took a few notes on this one. So I'm going to give you kind of the quick rundown here. This is actually a webinar we do. It's a 1-hour webinar on insurable value. I'm going to give it to you in about a minute here or less. So when it comes to insurable value, it's part of the lesser of 3 calculation. It must be accounted for. First off, one of the rules is never dirt. Don't ever include dirt in the valuation, and never use market value. Okay, it could be replacement cost value, but keep in mind there's a caveat. In order for the insurable value to be the replacement cost value, it has to be the primary dwelling of the borrower, which means they live there 80% or more of the time. So it might still be their primary residence, but if they don't dwell there 80% or more, like if they go south for the winter and they've got a second home, then they're not going to get replacement cost value. And so one of the big things when it comes to insurable value is make certain that you're never requiring more insurance than what will pay out in the event of a loss, because that would be unfair to the customer, right? Not to use UDAP on your customer, but that's kind of what it seems to be. It might be actual cash value. And that's really where a lot of these land. So how do you come up with that? Because actual cash value is replacement cost less depreciation at the time of the loss, which means it's a moving target. So maybe you could reach out to an agent that might be able to help you out here. There's also a thing called Marshall Swift. We're talking about commercial properties and things like that. But one of the guidance, the pieces of guidance that we've received from the regulators is that there are other methods to be relied upon here. And the big thing is that you document and support how you came to your conclusion. Probably one of the big ones that people rely on is not the appraised value, the hazard insurance value. Now, you could use the appraised value if it comes with the cost approach. Don't use market, cost approach would do. But many people look to the hazard insurance and say, if it's relatively close, we'll probably get a pass, provided that we support our conclusion by documenting the story, if you will. Now, that's the short minute and a half answer. There's more to this, obviously, but that's where I would try to keep things, is in that area.
Okay, this next one, when should we have an insurable value calculation for flood insurance purposes? And they're saying because they often use the loan amount, they don't always have an insurable value calculated.
Sure. So one of the things I mentioned in the previous question is make certain that you're not requiring more insurance that will pay out in the event of a loss. So we don't want to require somebody to be overinsured. So the lesser of calculation has three items: the outstanding principal balance of all loans secured by the collateral, the insurable value, or the maximum amount. It needs to be a consideration in all of your calculations to ensure that you don't overinsure something. Now, there are some black and white situations where you just know it's going to be the loan amount. But there are others that are not as black and white where it does come into play. So you need to be prepared to do that. Make sure you have a process and some procedures to give your folks a roadmap on how and when to come up with that information that we talked about with the previous question.
What is required to be sent to a customer when a loan has paid off? And does it vary by the type or amount of loan?
So Diane, I know this is one you and I chewed on yesterday. So from a compliance standpoint, let's strictly stay there. The only thing we could come up with is in the escrow requirements within RESPA, okay, you have to provide a payoff statement within 60 days, but you have to give them their money within 20 days. So if there's any money owed to them when the loan pays off that still resides in the escrow account, that has to be provided within 20 days. And then you got to tell them why you sent them money within 60 days. Now, I think that's just stupid. You have to send the money by day 20. You might as well send a note saying why the money is being sent in the first place, which would be that statement that needs to be sent out. So 20 days would be the only thing we could come up with within the RESPA rules. Outside of that, from a regulatory compliance standpoint, we couldn't think of anything else.
What are some best practices to indicate business purpose for a non-entity borrower for investment real estate transactions?
So this is another one that was pre-submitted, and I know we talked about it this morning, that I think the big thing is, all right, where's the line in the sand between when, as an individual, I'm buying something to invest in, but it's really more consumer investing than it is I'm buying it and it's a business investment. Okay, and I've seen all kinds of those in different loan files over the years, and Diane, I'm sure you have too. It really comes down to telling the story. What are the facts? If you don't provide information that the person that cracks open that file can rely on it and try to come up with what's going on, they're going to make it up for themselves. And just the way it happens is it's probably the opposite of what you were intending. So write a good story, okay, a factual story, not a fiction story, and that should help you out.
Okay, we have a couple on the Fair Credit Reporting Act. What is industry best practices to comply with the risk-based pricing notices or the credit score disclosure report? And they're asking, is documentation on our loan checklists and worksheets enough proof that it was provided? And should we document how and when it was provided?
So I think the reason for this question is it's because of what's not there with those model forms. There's not a signature line. Why? Because it's not required. And I'm going to encourage you not to have a signature requirement for these types of notices, the notice to home loan applicant, the credit score disclosure, and there's other things just like this, but rather you demonstrate a process. Demonstrating a process might be that you're able to show the auditor or the examiner that it just prints out every time. But it probably in best practices is some form of a checklist, or maybe you keep a copy in the file. There's lots of different ways for you to demonstrate how it's done in your organization. It doesn't have to be a signature line. And in this case, I don't recommend it.
For a home mortgage purchase, we may conduct a pre-qualification before we have a completed application. We pull credit at that time. Do we send a credit score exception and notice to home loan applicant then, or do we wait until an application has been received? And if the pre-qualification is denied, they do send an adverse action notice then.
Okay, so the credit score disclosure is triggered by loans that you are going to make that have been approved. Okay, not necessarily originated yet, but where you've not said no, because when you say no, they get a credit score notification as part of the adverse action notice. So just to set that straight. Now, back within that question, it talked about pre-qualifications. Understand that, and I'm guessing in this case, these are applications, pre-qualification applications, which means they trigger Reg B requirements, intent to apply, the appraisal notice, all that stuff should be triggered by that pre-qualification application, even though there's no property identified. And then the whole idea behind the completed application, that's really just about the 30-day clock, and it's not relevant to the discussion we're having here. So there's several things that will be triggered by the pre-qualification application, intent to apply, the notice to home, or I'm sorry, the appraisal notice. The credit score disclosure is going to be when you say yes. So if you're not saying no, eventually they're going to need to get that disclosure from you.
Okay, moving to TRID. We have been told differently by two different auditing firms whether or not we need a specific rate lock agreement, or does a revised loan estimate suffice as a rate lock agreement?
I think one of the key words is in the question, agreement. And when you think agreement, think of legal obligation or legal contract, if you will, which is going to be something that's covered by your state laws. So one thing that's very clear in the regulation is that the loan estimate and even the closing disclosure, they're not agreements. They're not contractual. I'm not contractually liable to them, nor the customer to the financial institution. So that loan estimate, that closing disclosure can't be a rate lock agreement because it's not an agreement. It's simply a disclosure. Now, why has this question come up? Because on the loan estimate, there's a space in the top of page 1 on the right-hand side that says, is the rate locked? And it's a simple yes, no. And if it's yes, additional information has to be provided. The CFPB, by way of the original regulation, when it was put out in the section by section analysis, they have a write-up that states that in order for the rate to be locked officially on the loan estimate, that there is this kind of inference that there should be a written rate lock agreement. And that's the stance we've taken since day one. If you don't issue a written rate lock agreement, even though you might say, hey, Diane, the rate's locked, okay, verbally, and maybe your handshake, your smile, your word is good, it's not really locked because you could pull it out from underneath of them at any given point in time because there's no written agreement in place. And remember who we're dealing with here. It's the Consumer Financial Protection Bureau. If the rug can be pulled out, that's not an agreement, and that's not going to make your disclosure be the best information that it can be. So if you don't have a written agreement, we encourage you not to check, yes, it's been locked, even though you might have a handshake or a wink or a nod or whatever going on.
Okay, staying with TRID, we struggle with title fee estimates and breakdowns at the time of the loan estimate, such as the terminology to use and how to transfer those items to a closing disclosure if the company ultimately uses different fees or terminology.
Yeah, so Diane, this is one that you near and dear to you, because I think over the last month, this is something you took a personal mission to go out and research and find out, what does it really say? And I think what we found out is it doesn't say a whole lot. I think it's true that when they did TRID 2.0, they tried to take a bite of this and they said, you know what, that tastes funny. And they spit it back out and they didn't go there. So the proposal for TRID 2.0 had something to address this in it. And they said, yeah, we don't like that. And then they just left it out of the final rule when they redid the TRID by way of that 2.0 regulation. So we're still left with this kind of, well, what are we supposed to do? And so here's kind of what we've come up, and you help me out if I'm not stating this right, because you did all the research here. You're the one that's going to make me look good when I say this. But the regulation basically says, look at the title company bill, and if you mirror that, you're probably good. Is that the plain English?
I would agree with that. Yeah. Yep.
So you're responsible to do the due diligence for the people that are on your shopping list, right? And so you should know kind of what their breakdown is because you've vetted them in advance. So it shouldn't be a problem there. When they go pick somebody not on your list, remember, they take on the risk. And when things don't quite match up, there is some flexibility in the regulation that as long as you let them shop, even though it's not something that's listed, that it's still part of your 10% tolerance. Okay, now if they go and pick somebody on your list, that's not part of your tolerance anyway, that's unlimited. So I guess I may be confused people. If they pick somebody not on your list, it's all on them. Now, what if the service doesn't quite match up with yours? Well, it might have been packaged in by the title company that you had them shop for. And so those shouldn't be a violation, at least not based on the way we've read it. But yeah, there's still kind of a hole here. Would you agree, Diane?
Oh, absolutely. Yes.
That's why you spent the weeks researching it. So here's something cool I want to share with all of you. So I'm going to share my screen again. This is brand new, so I'm kind of excited to do this. And give me just a moment here, folks. So I'm going to put up on the screen, I'm going to share a slide here. So we have a magazine, and we think it's pretty darn great. It's called Banking on BCC. And I know a lot of you are loyal subscribers, and you get this written word from us every month, and it's in plain English. And hopefully it's helping you and your teammates do what you have to do day in and day out better. And you're moving from good to great based on it. One of the things that you're going to be seeing in our, is it next month that this is going to fly?
Yes, February.
Okay, so February version of this, we are going to include this article that Diane has been researching on TRID and title insurance components. If you're not familiar with our Banking on BCC magazine, I'm going to share with you a QR code. That's what that circle is. If you take your phone up there and do the phone magic with the QR code on the screen, you're automatically going to be included to receive a sample copy of our Banking on BCC magazine. Check it out. I hope you love it. If that's something you're interested in subscribing to, or you have questions, pick up the phone, reach our team. Otherwise, you can just go subscribe online. And just like anything else we do, it comes with a delight guarantee. If it's not something you're delighted with, we want to hear from you, and we'll figure out where to go from there. So that's something to look forward to, those of you that are subscribers. And if it's something you're interested in as far as the magazine, go ahead and use that QR code to get a sample, and we hope you love it and you'll become one of those subscribers as well. All right, Diane, let me fix my screen here and we'll be back to the questions. All right, you're up.
Okay, we're going to move to some Regulation B questions.
Oh, okay.
We accept a completed 1003 before the applicant has a property as a Reg B application. We pull credit, send an appraisal disclosure, and issue a denial or a conditional pre-approval. If the customer then enters a purchase contract within 60 days, we have the customer complete another 1003. This is our TRID application. If just prior to closing, like in another 45 days, the loan is denied due to verifications or an appraisal issue, we promptly send an adverse action. We were criticized by an auditor for failing to send the approval or denial notice within 30 days of the TRID application.
Oh, there's lots to unpack there. Let's start with, we accept 1003s before as the request, okay, before the property's been identified. I think that's pretty common. Just remember that a piece of paper is not necessarily an application, but that might be the first piece of information you get. Okay, but if I pick up the phone and call Diane and say I'm interested in going out home buying and shopping, and Diane says, well, do you have a property? And I'm like, no, but she takes a bunch of information. That's an application too. So it's not a piece of paper. And that's another one that we cover in a webinar, applicants and applications. And if that's something you need help with, do me a favor and check that out. So the request for credit happens when they do this pre-qualification on, or pre-approval, whatever you want to call it, where there's no property identified. Just understand those are applications. So you have to do something with them. And so you're going to do this quick and dirty math and probably very little verifications to give them a letter that says they go out house shopping. And then once they identify a property, they're supposed to get back in touch with you. Well, I do have a concern with part of this question. It says, if the customer then enters into a purchase contract, understand the purchase agreement does not drive TRID. It can, but it can't solely be the driver. So if I have been pre-qualified with Diane, she's my loan officer, and she said, well, let me know when you sign a contract. And I call up Diane and said, hey, I haven't signed a contract yet, but we're really thinking hard about 1023 Oak Street. Well, I think we're looking at possibly making an offer. I'd like to know what it costs. Now Diane has the property address and likely everything else from a TRID perspective, but I haven't signed a purchase contract. I'm very concerned that there are lenders out there that will not provide loan estimates without having a signed purchase agreement. Understand that's not the spirit intent of what TRID is all about. TRID is about getting shopping disclosures in borrowers' and applicants' hands so they can decide whether or not they should enter into a purchase contract on 1023 Oak. or the house down the street, or whatever it may be. If you're requiring a purchase agreement, that's an extra step, and there's more risk in it for the customer, because when a purchase agreement is triggered, usually they have to put money down. And so that's something, if you read in the consumer compliance highlights from the CFPB, the OCC version, the FDIC version, they've all come across this. The CFPB on a number of different occasions has said, wait a minute, folks, you've gone too far, and we're going to be looking very closely at this. So that's a concern I have within that question. Now, the thing about the auditor criticizing the bank for not providing an approval or denial within 30 days of a TRID application, that clock isn't started until the application is complete. Now, that's another discussion that there's a whole different can of worms, but you have to decide, are we going to go with a completed application based on unverified information or verified information? Most go with verified information, which means until you have W-2s, tax returns, pay stubs, all that, the 30-day clock hasn't even started yet. Yes, you have a TRID application, but you don't have a completed application yet. And even if you have a TRID application, you might not have an unverified completed application. So without having some more facts, but based on what was presented, I don't agree with your auditor saying that just because you have a TRID app, the 30-day clock has started. I would say it's not yet complete.
If during an audit or review, we find an error on a notice of adverse action that has already been sent out, should we send out a new one showing the updates?
I'd let that sleeping dog lie, move on. I would, why did it happen? What are we gonna do to make sure it doesn't happen again, and move on?
In a situation where we have a TRID application, but the applicant has frozen credit, should we deny the application if credit is not unfrozen within the first 3 days? If not, what would be the other option?
So there's really two options here. You either send a notice of incompleteness because you've asked for something and can't get it because you don't have access to it because it's frozen, or you deny it because it's incomplete. Now, if you call the customer before you've sent the notice of incompleteness or denied it for incompleteness, and they say, yeah, never mind, then it's an express withdrawal before you do any of those other things. So there's a couple different ways this could go.
Okay, we'll switch gears. On consumer open-end lines of credit and HELOCs, overdraft lines, we have a minimum standard advance amount of $100. However, if the borrower requests a different amount, is it okay to just include this verbiage in our note? Specifically, do you see any fair lending issues with this? The minimum advance amount is always $100 unless the borrower requests otherwise.
So the minimum's $100. I assume it's because the borrower wants more, right? That I'm going to read between the lines there, because the bank has a $100 minimum just because it costs a certain amount of resources to process an advance. So we're just going to say nothing less than $100. So if somebody wants more, that's fine. You're going to have that minimum already in your agreement. And if you go over that, that's fine. Now, you wouldn't want to be inconsistent between one borrower to the next on how much you're going to allow them to advance over the 100. And I don't think I've ever run into that, but I mean, that would be a concern, but I'm not, maybe there's more to this, but I don't see on the surface the way the question is asked that there's an issue with this.
Okay, moving back to flood insurance. Is the addition of force-placed flood insurance premiums to the loan a Meyer event requiring a new notice? And in that scenario, if it is a Meyer event, can we depend on the previous determination?
Okay, so the proposed flood insurance FAQs, and I can't believe they're still proposed, not final yet, but they are. But I also don't think that we can't rely on them either, because there's a lot of information that's already changed. The fact that they haven't formally rubber stamped them through, I think it's just a matter of a formality. But here's the thing. The guidance, whether it's by way of those proposed Q&As or guidance that came before that, they basically say this: as long as your contract has verbiage in it that allows you to force place insurance and add any premiums to the loan, and usually it talks about hazard insurance or just any insurance in general. I don't know that I've seen a loan that doesn't have the language, to be honest. So as long as that language is in your legal agreement, you're allowed to force place and add the premium for the force place coverage to the loan balance and it not be a Meyer event. That's what the guidance states. However, if that language is not in your legal agreement, then it is a Meyer event, which is going to trigger the whole flood game. New determination, new notification if it's in a special flood hazard area, which it probably is if we're force placing. You have to recalculate the dollar amount, which is kind of like chasing your tail, because you had a dollar amount, now you're adding the premium. So now that went up. And so it just, the whole thing is going to be a minor event triggering all the flood insurance requirements if that language is not in your legal agreement. Check. I'm certain in most cases it probably is, though.
In what areas can flood penalties be assessed? And what are the more common violations cited in which financial institutions are penalized?
All right, I'll give you the rundown here of the civil money penalties. This again was one that was pre-submitted, so I went and printed the list. Failure to require flood insurance, failure to provide the special flood hazard notice, failure to force place, failure to escrow. There's an escrow requirement for many institutions. Okay, there's some exclusions, but there's an escrow requirement for most. Notice to the applicable servicer upon transfer. So if you transfer the loan to the servicing, there's a notification requirement. And then there is the requirement to accept private insurance. So I count there's 6 different violations, if you will, and then there's varying degrees of them, but they could all lead to a civil money penalty for each singular violation. So I don't know that if you could have all 6, but let's say you could crack open one loan file and you could have 4 or maybe 5 different things go wrong with it. Each one of them be a single civil money penalty that is $2,000 plus per violation. Now that's gone up with the consumer price index. It was originally set at 2,000, and I've got the 2021 number here. It was $2,250 per violation. So you could easily go over the $8,000 mark with 4 violations in a singular file. Most common: failure to require, failure to provide the notice, failure to force place. I think those are probably the big one. I don't see so much for the private insurance, the servicer, or the escrow, but failure to require insurance, provide the notice, and to force place would be some of the bigger ones or more common ones that we see.
Is it okay to modify an unsecured line of credit to increase the credit limit or extend the maturity date rather than doing a complete refinance?
Yes, and then I'll give you our take. It's got to be done before the maturity date. Once something matures, it no longer can be modified because it has matured. You've got to do something brand new then.
Okay, we'll move to some HMDA questions we received. We are looking at working with our local Habitat for Humanity organization. We will be completing the loan documents, closing the loan in our name, and funding the loan. And the loans will be on our books, but we will not be making the credit decision. Will these loans be HMDA reportable?
Okay, so this is another one that was pre-submitted, and Diane and I, we chewed on it yesterday afternoon, and then we had a little cram session here this morning. And then right before the start of this thing, lurking in the background was our HMDA king, Dave. We got his opinion on what he had seen over the years with Habitat for Humanity. And what we came to the conclusion is there's lots of different ways this can happen. So the question seems to indicate that there's a loan being made. I'm going to go out on a limb. It's probably new construction, but the construction only variety. What it states is that the Habitat is going to be underwriting the loan. They're going to be qualifying the borrower. And then the bank's going to be the one funding the loan, and it's going to sit on the bank's books. Based on the information that was shared, it would appear that this is an origination that needs to be reported as a purchase. It's going to be construction only. It doesn't appear that anything is going to follow, so it's not temporary followed by permanent. But based on what was presented, this one would be an origination that would be a purchase. Now, having said that, when we had our little session before this Q&A this afternoon, and then even Diane and I yesterday and the day before, there's different ways these loans, sometimes banks purchase a whole pool of them. Sometimes they purchase a singular loan. Sometimes they're purchasing as part of a participation. Sometimes they're actually making the loan like this scenario, and that this one would be reportable. So it depends on the facts and circumstances of each particular situation as to whether or not it would be something you would report.
Okay, sticking with HMDA. Say a borrower gets a 12-month loan for a down payment to purchase a new primary residence, and it's secured by their current residence. When their current home sells, they pay the 12-month loan off. Is this HMDA reportable?
Yeah, so what I gathered from this is it's bridge only, because when the home that's collateral sells, there will be no other financing beyond the loan that we've made. So bridge only gets reported. We have a dwelling secured loan where it was used to purchase another dwelling, albeit a bridge, okay, but it's bridge only. That gets reported, okay? That's a single phase financing. The only way you wouldn't report that bridge is if there was 2-phase financing, where when we sell the dwelling that secures the loan that we used for the bridge, that won't completely pay it off. And so we're going to carry that financing over and do something else with it. Then you wouldn't report the bridge, you'd report what comes next. This is bridge only, it gets reported.
If we have a commercial non-revolving line of credit deemed HMDA reportable with a note date of January 22nd, with payments due on the first of each month starting February 1st through January 1st, 2024, what should be reported as the loan term? In other words, what happens to the odd days? Do we round to the nearest whole month, always round up, or drop them off, not count them?
Okay, well, we have to go back to the first part of this question because there was some verbiage that was used that I think we need to make certain we're all understanding the same way. So the language that was used, I wrote it down, was commercial non-revolving line of credit. So a multiple advance closed-end loan is what I would call that. Multiple advance closed-end loans are loans, closed-end variety for HMDA. That's important because there's a difference between what you do with a loan and a line that's revolving like a credit card where I can draw, pay it back, draw, pay it back. Okay, so here's the deal. If we're talking about loans, closed-end variety, which it appears this is, okay, you're going to go from the first payment month through maturity when you count whole months, and you only report whole months. The odd days just roll off. We don't round up, we don't round down. It's whole months, first payment through maturity. If we're talking about lines, it's a little different. You go from the date of origination through maturity. So it's important to understand the product we have so that we get the correct time frame utilized when counting that term. So it's always whole months regardless, but what we start from is what we have to make certain that we get correct.
When there is more than one co-applicant or co-borrower, how should the co-applicant and co-borrower be determined regarding who will be reported on the LAR as the co-applicant or co-borrower?
Well, let me start with this. If you have multiple co-applicants, just understand you need to collect race, sex, and ethnicity on all co-applicants. But from a HMDA standpoint, you're only going to report the first co-applicant. Now, the question is, if I have the applicant, the primary borrower, and let's just say there's 3 co-applicants that come with it, how do I decide which one is going to be the one that's reported? The order in which you get them. So if it comes in on a paper application, that's the order. If you're taking the application over the phone and Diane starts rattling off who the co-applicants are, maybe I'll ask her, what order do you want this to go in? Or maybe I just do it the order in which she provides them. That's probably the best to go. And so the order in which you get them is my answer.
If occupancy type is coded as an investment property, is the loan always business purpose? And if it's case by case, how do we determine whether it is business purpose?
So I think this one throws people because it's like they didn't give us enough options. So understand that the field is applicant occupancy, right? That's the field. And so the options then are going to be, is it the applicant's principal dwelling? Is it a secondary residence? Or is it an investment property? So if the the applicant is a person, okay, and it's not their primary dwelling, and it's not a secondary residence, it has to be investment. The example I always give is this: if my mom lets me use her home as collateral so I can go buy my new boat, that's not a smart decision on her part, but it'd be super cool. That's an investment property. Okay, I don't stay at my mom. She has her own house. I have my own house. It's not a second. I mean, she lets me come over for supper once in a while, but she makes certain that I go home. So it's not even a second home. It's got to be an investment property. So investment property, I'll go back to the question. If the occupancy is coded investment property, is it always business purpose? No, because in that scenario where I use my mom's house to go buy my new boat, that's consumer purpose all the way. So the answer is it does not have to be business purpose. It could certainly be consumer purpose.
Okay, we'll go back for a couple of TRID questions.
Okay.
What are your thoughts on issuing early closing disclosures? And this individual says they're having issues with the title companies and management is interested in issuing early closing disclosures to expedite closing. But as a result, the final fees would be significantly lower. They're concerned this would not be in good faith and would have some fees that we know the amount, but the early closing disclosure would only reflect the amounts as disclosed on the loan estimate.
My short answer is going to be, I don't like it at all. I understand the why behind it. And there's even a path to somewhat do this, but you shouldn't be issuing closing disclosures any earlier than 1 week out. Now, why 1 week? Because a week is kind of a given timeline that if we drop the disclosure in the mail today on Tuesday, Wednesday, Thursday, Friday, it's in hand. Saturday, Monday, next Tuesday, we can close. So that's a given in the industry that you can do it at least that early. Now, that's not an early closing disclosure. That's supposed to be the closing disclosure. And then if something happens in that week that causes that to be no longer current or the most up to date, then you provide an updated version. And that's all accounted for in the regulation. If you're choosing to issue a closing disclosure any earlier than a week out, understand you're going to have concerns that are going to be around the good faith item that was mentioned in the question. Is it the best information reasonably available? And you still, in order to provide that disclosure earlier than that week out, you still have to reach out to the third parties. The regulation says you need to do your due diligence. And so you have to call the title company, you have to call the attorney and the realtor to get the information and make an attempt. And only after you've made the attempt and not gotten the final numbers can you do this good faith guess as to what the number might be. But the regulation also seems to indicate that if you're earlier than a week out, what are you doing this for in the first place? Now, there are special circumstances where the borrower might say, I'm going to be out of town or something pops up, but to do it all the time or on a large percentage, I can't go along with that. I don't think that's in line with the regulation at all.
Okay, what if we do not allow shopping for settlement services and do not have a shopping list, but allowed an applicant to shop in error by letting them pick a title company after the loan estimate was issued? In this case, our tolerance is held at 10% or at 0 for added or increased title charges due to the change in title company.
So this is one of the things that TRID 2.0 kind of threw us a bone in the industry and said, all right, if you didn't let someone shop for a particular service, or maybe like in this case, you didn't let them shop altogether, at least that's what you were trying to indicate, but you decide kind of on the cuff to let them go and pick their own provider, will that then allow the fee to be moved from the 0% bucket to the 10% bucket? And TRID 2.0 says that as long as you can demonstrate that you gave them the opportunity to shop, even if you didn't give them a shopping list, okay, it can be part of the 10% bucket in actuality. Now, you won't be able to increase the 10% bucket on the loan estimate side, but it can be part of the 10% bucket as it relates to the actual fees being charged. So just remember, whatever you failed to show that you're going to let them shop for, hey, your 10% tolerance is going to be it's going to be less than that. You're going to be already off by what you failed to have showed that you'd let them shop for. So it'll be on the loan estimate, but it wasn't on the shopping list. So, I mean, you're going to have the failure to provide a shopping list. There's some errors that go with it, but you get a little bit of grace. It's not a thing that I would plan to do often, but when it happens here or there, it's not going to be the end of the world either.
Okay, Regulation B and joint intent. Does it matter if applicants sign to verify joint intent on our initial or final application? Should they sign both, or is one sufficient?
Okay, so intent to apply has to be documented at the time of application. That's the regulatory requirement. Now, if I call in and apply over the phone with Diane, and Diane writes down that she talked to Jared, and Jared said that Tina and Jared were going to be the joint applicants. If Diane wants to have me sign something later on, whether it's during the application process or even at the closing table, that verifies the note that she took over the phone, that's fine. That's not a regulatory requirement. It might make her sleep better. It might even help in court possibly. But the regulatory requirement says there must be documentation at the time of application, which means if it's in person, signatures or initials. If it's over the phone, there should be documentation from the loan officer about who they talked with and what they stated.
Okay, we have a couple that are review-based. Should a compliance audit schedule be risk-based? Is this what examiners expect to see now, as opposed to trying to audit everything annually?
Yeah, absolutely. And I don't think this is brand new. I mean, I think a lot of organizations have been doing this for quite some time because resources are limited and there's so much to do, right? I mean, we're not struggling for job security when it comes to compliance by any means. There's just way too much to do in most cases. So it has to be risk-based. So I think absolutely moving in that direction, if you're not already, is the way to go.
Okay, this next one, how often should an internal fair lending review be done? 12, 18, or 24 months are what they're throwing out there for possibilities.
Sure. That last question we took is absolutely the answer to this. It should be risk-based. So hopefully you've done a risk assessment for your organization. There's no regulatory requirement that you do one for fair lending, but we opened up the session today saying that fair lending is super hot again. In fact, hotter than it's ever been. And I know you've heard that record play over and over, but it's like more than ever now. I mean, if you go back and look what happened in November and December with press releases, it's crazy to not imagine fair lending be at the top of the list of priorities. So I think a risk assessment for fair lending is a good place to start. And then that will tell you, based on the risk and the resources available to you, how you should go about doing fair lending and how often, and whether it should be internal or external based on the resources you have available.
Okay, this is one on mortgage servicing that came in during the forum here. We have a loan customer who does not want to receive any notices, mailed or electronic. Can we shut these loan notices off without violating any regulations?
You can go about shutting some things off, but you can't shut everything off. For example, periodic statements, they can ask to be electronically delivered, but you can't stop providing a periodic statement when it comes to mortgage loans. That's one off the top of my head. I'm sure there's some other things that you can't shut off. So there's some things you can shut off, but you can't just shut it off altogether. There are some things they must receive. Now, it could be electronic, e-sign compliant, if you will, but you just can't shut everything off.
Okay, APRs. The CFPB website states that the tolerance for an APR is no more than 1/8 of 1% above or below. And this individual is saying, I thought that an overstated APR was okay.
Okay, so if we're talking about mortgage loans, overstated APRs from a regulatory violation standpoint are not going to be violations. Okay, I think I've got that right. Correct me if I'm wrong, Diane. But it's still utilized as a basis for redisclosing TRID disclosures. So even though you might not have a violation because the APR was overstated, understand that there are still certain circumstances where you could have an issue, and TRID also has a play here. So you might not have a violation, but you might need to redisclose TRID disclosures within a certain time frame, depending on whether it's over the eighth or the 1/4% tolerance or under the 1/8 or 1/4% tolerance. So TRID references those, and then there's the APR side of it too. You have to understand both in order to make sure you get this right. So yeah, I can agree, not a violation, but you still may have to redisclose some things.
Okay, we have a few that came in as follow-ups to some of the earlier questions. For this first one goes back to the question we had on credit reports, on single versus joint reports. And they're asking, if we simply pass along the exact fee we are charged for credit reports, would there still be an issue?
Absolutely. So if your credit reporting agency is charging you $25 for a joint application or for a joint credit report and $15 a piece for individuals, okay, you're going to do just like I would. You're going to tell your auditor, well, I'm just passing along the charge that was passed on to me. It's not going to matter that it's a third party involved. When the examiner looks down and says, what's the difference between these two applicants? These ones are married. These two applicants are not. The two unmarried applicants got charged $5 more than the married applicants. Marital status is one of the 8 things that cannot be part of the consideration in any aspect of the transaction. And that's the only way they're going to be able to look at this. So I get your argument that it's just a pass-through fee, but at the end of the day, the difference is marital status. And if that's the case, that's one of the protected characteristics that cannot be a differential in your credit decision-making process, any aspect of it. So probably not the answer you were looking for, but that's the answer you're going to get from the regulators.
Okay, this next one goes back to the discussion on credit score disclosures and documenting, providing them. We put a copy in the file and have the customer sign or initial it, and they're just wondering, why do you say not to have them sign the disclosure?
Because there's lots of disclosures out there that are like this one that don't have a regulatory requirement as far as a signature goes. And I'd ask this person if they were in front of me this. You also provide a privacy notice. Do you have them sign that? On the deposit side, you provide truth and savings disclosures. Do you have the customer sign every truth and savings disclosure? And I could go on and on. There's several notices and disclosures like this. Just because you have initials or a signature line doesn't necessarily mean compliance was done correctly or not correctly. So demonstrate a process. Here's an area where the regulation doesn't require you to have the customer sign something. there's already enough burden of signatures with everything that's required to be signed. Why add one more piece to the puzzle when you can simply use a checklist or some other means to demonstrate a process that doesn't go so far as having your customer pick up the pen and put it to paper?
Okay, this one takes us back to that question we had on whether a 12-month down payment loan was HMDA reportable.
Okay.
Can you please restate your comment that single phase bridge loans can be considered purchase loans for HMDA and considered reportable?
Yeah. So in order for a bridge loan to be exempt from reporting, okay, and the bridge loan scenario we're talking about here is I've got dwelling A. We're taking equity out in it to make a down payment on dwelling B. The loan is secured by dwelling A. But when dwelling A is sold, okay, the loan A that we made for the down payment on loan B or on dwelling B is going to be completely paid off. So you have a dwelling secured loan that is used to purchase another dwelling. Okay? HMDA is collateral plus purpose. I have a dwelling. The purpose is to purchase another dwelling. That's what makes it HMDA. Now, the two-phase financing thing, there's not two phases. Based on what was shared with us, that was the only phase that's ever going to exist. So this is bridge only and therefore reportable. If it was bridge followed by something else, then we wouldn't report this down payment loan. We'd report what follows it, the next phase of the financing. But there'd have to be two planned phases. And then you wouldn't report phase one because you're reporting phase two.
Okay, we will go back to flood insurance and cross-collateralization.
Oh,
What if the note or security instrument contains a cross-collateralization clause? In that case, do all loans have to be included in the flood insurance calculation? And would the flood notice to the borrower need to be provided for all loans?
okay. Well, I want to make sure you're thinking bigger than just flood loans here, but let me answer the exact question. So if there's cross-collateralization language in a security document, like a security agreement, or the deed, or the mortgage, or the loan itself, absolutely that's going to carry forward to every debt that follows where that same borrower is involved. Now, you're thinking in the realm of just flood loans. I need you to think bigger than that. Obviously, if we do a subsequent loan and it cross-collateralizes back to a loan that's secured by collateral in a 100-year floodplain, we needed to have done a determination, a notice, recalculate the amount, and all the stuff that goes along with flood insurance. Hey, I think that's the part that everybody gets, and that's the part I think that this question's about. So the answer is yes, but I'm going to go one step further. It's not just about flood loans. If you make a loan today that's secured by improved real estate, walled and roof structures, okay, to me, okay, and let's just say it's a business purpose loan, okay, and then and I give you my house as collateral, and in the deed or the mortgage, there's a cross-collateralization clause. And let's say 6 months down the road, I come to you to get a new pickup loan for our plumbing business. Hey, that's the business I'm in. And so you make me what you think is a loan that's just secured by the pickup for my plumbing business. Well, guess what? 6 months earlier, you took that deed of trust on my property, and in there was a cross-collateralization clause. Hey, now my house is not in a 100-year floodplain, but it's automatically going to carry forward to that pickup loan that you made me 6 months later. Guess what you also need to do there? A flood determination. So it's not just something that affects loans that are secured by 100-year floodplain collateral. It's also any loan, because you've got the determination requirement because it is real estate improved. You'd have a failure to do a flood determination on that pickup loan. We might say, well, that's not a big deal, but think about all of the loans that you would have missed those determinations on. That's the bigger deal, or one of the big deals along with the flood loan side of it.
Okay, back to the Fair Credit Reporting Act. Can we reuse a credit report? For example, if a customer applies for a boat loan and then 4 months later comes in for a different loan.
As far as the Fair Credit Reporting Act goes, yes. You might want to check your contract with your credit report vendor because they may limit you, but the Fair Credit Reporting Act in this scenario does not.
Okay, we have another TRID question on disclosing taxes. And they're saying they have a situation where the 2022 taxes are cheaper than what will be in the future, 2023. And so they're wondering, are we correct to do the loan estimate and closing disclosure based on the estimated taxes for 2022, what is immediately coming due, I'm assuming?
Okay, so the loan estimate requires you to forecast. The closing disclosure allows you to forecast or do actual. Typically what I see is actual done on the closing disclosure, so current year, whereas the loan estimate requires you to forecast what they will be in the future, and it doesn't give a drop dead time frame. It just says forecast. And I don't know if you use exactly those words, but it's you have to look off into the future.
How do you document a complete loan application if you don't use the TRID application date?
So just because you have a TRID app does not mean you have a completed application. Reg B does give you flexibility to determine what you believe is a completed application. And my short version is going to go like this. And if you want the longer one, I'm going to invite you either to go check out our applicants and applications webinar on demand in our training library, or we've got a live version of that that'll be coming up here in the next couple months. But you've got some flexibility to decide how you're going to determine what a completed application is. You can do it based on unverified information, which could tie it back very close to the TRID loan application. But remember, even unverified information is going to be probably more than the TRID 6. So I don't think you can say TRID 6 is our unverified completed application. That's what we're going with, because I think there's still more information that you're going to want to have beyond that. But also understand the limitations of TRID. You can't require certain things over and above the TRID 6. So I think trying to tie the completed application back to the TRID 6 is just a dangerous proposition. Rather, there's the verified information. I'm not going to consider it complete until I have W-2s, tax returns, pay stubs, and all the verification documents. The only thing it changes is the 30-day clock and when it starts. You still have to comply with all of the other elements that are out there in compliance when you provide different notifications and so on and so forth as far as disclosures go. The completed application really is only tied to that 30-day clock to communicate the decision.
Okay, this person is wondering, making sure they heard correctly, that a notice of right to receive appraisal is required for a pre-qualification or pre-approval when no property has been identified.
So our take on Reg B is this: the appraisal notice is required for any application that is or will be secured by a 1 to 4 family dwelling that is a first lien. Reg B defines application as an oral or written request for credit. Pre-approval or pre-qualification applications are absolutely applications under Reg B and would trigger that requirement. A pre-qualification inquiry or pre-approval inquiry would not trigger the requirement. So inquiries, no; applications, yes. But pre-qualifications and pre-approvals can be applications.
Okay, if we counteroffer the loan amount and the applicant declines to go forward with the loan, do we treat this as a denial?
So if I decline the opportunity to move forward with your counteroffer, there's 2 ways you can go about it. You can just go back and straight up deny me for the original request. If we're talking Reg B, you can straight up deny me for the original request, or you could send me the counteroffer denial and allow me to continue to think about it, I guess, if you will, or to call me back. But it would simply state, thank you for applying for A, we were offering you B, and let us know by a date that's no more than 90 days out. You could still send that, even though they say they're not going to take you up on it. Most would probably go back and just send the original denial, though, and just deny the original request. Remember, HMDA has a little bit different take on that. If they don't accept your moving forward, you're going to report the disposition of the original request.
Okay, back to adverse action notices. Is there an issue sending out an adverse action notice for loans that were withdrawn?
Yeah, why would you send out? Why would we send out an adverse action note, like a no, if you will, or a no but counteroffer, if somebody has withdrawn? Because you can only, so somebody expressly withdrew and we're still going to say no, or we're going to still going to say no but. I don't know that I would do that. If somebody withdraws before we do that, I'm going to document that they withdrew expressly before the credit decision was made. Am I missing something there, Diane?
No, I don't think so. No.
All right. Well, I tell you what, I can't believe it, folks. Time has flown by. We are a minute out from the top of the hour, and I want to respect all of your time. So before you all go, let me do this. I want to share my screen one more time with all of you. And I've got just a couple of quick closing comments here. I want to give you some instructions on where to get some additional information here. Let me share my screen. There we go. All right. So probably the big thing in our closeout here is making sure you know what comes next. So we did 1 hour of lending Q&A here. We are going to do in May on the 5th, and you can begin registering immediately, the deposit compliance question and answer. And we've also have the next 2 forums beyond it. So all 4 of them, if you want to go out and register to make sure you've got a seat for each one of our forums in 2022, you can go out and get registered for them right away. We put them out there so that you can reserve those dates and times, but we'll be doing deposit compliance Q&A in May. You can begin pre-submitting questions. We try to take a little from the pre-submitted group, and we try to take some live stuff, and it's a mixed bag. And like I said at the outset, the goal is to get to as many as we can during that 1 hour time frame. So here's the deal. There's likely a survey that popped up in a window behind the screen, and we'd love you to just it'll take you less than 60 seconds to give us a little feedback today on how we did with this free lending compliance Q&A forum. The recording, we'll turn that around in 2 weeks or less. Usually it's much quicker than that. That way you can go back and listen. We covered a lot of different things here today. I want to say we took upwards of 50 questions today. If you need to go back and listen to something, share it with a teammate. It's going to be there for you to do that. When you download that, after you've been notified, do us a favor, rate this program just like you would an eBay purchase, an Amazon purchase. It helps those that are out browsing the store trying to find something that might meet their needs when it comes to regulatory compliance. That said, if you had a question we weren't able to get to and you still need that answer, that's what we do. We have a quick response consultation opportunity for you to get checked up on. If that's not something that you've talked to us about, give us a call. Let us know if that's a service we might be able to partner with you on to get those plain English answers to you on a day in, day out basis. With that, again, I want to respect your time. And I think now it's time to let you all get back to what you do so well, and that's serving your customers. On behalf of our team, thank you for stopping by for today's Lending Compliance Q&A forum.